Good morning, everybody. My name is Dan Michelini with Filice Insurance. We're going to get started here. Hope everybody can hear me. A couple of housekeeping items. If you look on the dashboard on the bottom, there's a couple of buttons there. The most important one is the Q&A button. If you hit that, you can ask questions about either the content or if you're having any technical difficulties, and our moderators will be available during the presentation, as well as we'll keep it open for 5 or 10 minutes or however long is necessary after the presentation to continue answering any questions that you might have. So feel free to type in your questions as we go through this process. And then, if you have any follow-on questions, the moderators will provide contact information, both email and phone number, that you can follow up with after the presentation. We'd be more than happy to speak to you directly about any particular or specific questions that you may have regarding your organization. So today's webinar is focused on alternative funding mechanisms for your health benefits. We're going to talk specifically about self-insured models, why they may be appropriate for your organization, and some of the market dynamics in the health benefits industry that are driving greater penetration of these alternative funding mechanisms. Before we jump into kind of the nuts and bolts of alternative funding, wanted to review first kind of some traditional health plan designs. You guys are probably all pretty familiar with these, but I think it's a good starting point. If we look traditionally over the last 5, 10, 20 years, medical benefits and how they have been structured, there have been three kind of primary traditional plan designs. Number one is an HMO, Health Maintenance Organization. An HMO is an in-network only health plan where you engage with a health insurance carrier, a Cigna, an Anthem Blue Cross, a United Healthcare, Aetna, whoever that might be. They provide services only with in-network providers. In an HMO structure, you need to actually select what's called a primary care physician. Your primary care physician manages your preventative and routine episodic care, but they also serve as a gatekeeper for any access to specialists. So if you need to see a cardiologist or a dermatologist or an orthopedist, basically any provider that has an IST at the end of their title, you need to access the specialist through your primary care provider referral. So traditional HMOs have usually been less expensive. That dynamic has changed a little bit in prior years, specifically depending on where you're located. Northern California, HMOs are much more expensive than they are in Southern California, but it's also a more restrictive plan in that it only provides in-network coverage. We also have what's called a PPO, Preferred Provider Organization. In a PPO structure, you have access to both in-network and out-of-network providers. An in-network, in both an HMO and a PPO, refers to providers that have contracts with your carrier. And those contracts provide you with their network discount. So it's really kind of the difference between paying retail, and that's what the doctor charges, versus wholesale. That's what the doctor has contracted with insurance carriers to charge their subscribers. So in-network services, again, are always going to be less expensive because you get the benefit of the contracted rate. But the PPO does allow you to go out of network and see any provider you want. So there's much more flexibility. But if you go out of network, you lose the benefit of the contracted rate. so you will be paying retail as opposed to wholesale. And in the PPO structure, the benefits, the percentage that the carrier pays is less for out-of-network providers than it is for in-network providers. They lose all control over costs when you go out-of-network, but the PPO does provide you with that flexibility to go out-of-network. In addition, in a PPO, you do not need to select a primary care physician, nor do you need to get referrals to go see specialists. So again, much less restrictive, much more flexible plan design. Third plan design that used to be much more common, isn't as common anymore, but was called a point of service plan. A point of service plan was a bit of a hybrid where if you go in-network inside the HMO network, you get the best economic deal. Your costs are the lowest. You also have the flexibility to go to the PPO network, where again you get the benefit of the contracted rates, but the carrier pays a little bit less, you pay a little bit more. And then you also have the full flexibility to go out of network, a completely non-contracted provider, but if you chose to do that under a POS plan, you would pay the most and the carrier would pay much less. So it really provides three tiers under a point of service plan, but great flexibility. The point of service is kind of fallen out of favor, but we do see it at times being appropriate for certain populations or employer groups. Last plan design I want to note are high deductible plans. Way back in 2003, under the younger Bush's presidency, the Medical Modernization Act was passed, and Medical Modernization Act included legislation around HSA plans and hence started to drive popularity for high deductible health plans. A high deductible health plan is effectively a trade-off in that the plan design has a high deductible, and this deductible, the minimum now is $1,300 per person, and it's a first dollar deductible. What that means is the carrier does not pay any benefits other than your annual preventative care visit. But outside of that, they pay nothing until you've met your deductible. And like I said, the minimum is $1,300. We see deductibles up to $2,000, $3,000, $4,000 per person. And most plans have a 2 times the individual deductible is your family deductible. But you do not receive any benefits from the carrier until you have paid your full deductible amount, depending on your plan design. The benefit is, the trade-off is, these high deductible plans have lower premiums, so the amount that you pay to the carrier on a monthly basis is much lower. However, you pay more when you actually utilize the plan because of the first dollar deductible structure. Next thing I want to talk about, again, just to kind of set the stage for alternative funding mechanisms, is the rating methodologies that we see used in the state of California. So you guys have all heard about and are probably somewhat tired of hearing about and keeping pace with all the changes that came with the Affordable Care Act that was passed almost 6.5 years ago in March of 2010. One of the provisions of the Affordable Care Act is it expanded the small group. Small group traditionally was 50 employees or fewer, considered small group. 51 and above was considered large group. The Affordable Care Act initially expanded the small group to 100 employees. This brought about a lot of complexity because in the small group, you have age-banded rates, and one of the big changes with the Affordable Care Act, in addition to expanding the size of the small group, was they went to member-level rating. What that means is they look at the age of the employee, Then they look at the age of the spouse, if there is a spouse. And then they also charge you for each child you have up to 3 children. If you have more than 3 children, the 4th and beyond are added to the plan at no additional cost. So these rate tables now are very complex in that the ages are set at single-year age bands. So a 34-year-old rate is going to be different than a 35-year-old rate, and a 36-year-old rate, and a 37-year-old rate. These rates are also filed with the state, so there's no negotiation. Once they file these rates with the state, if you're a 34-year-old female, you're going to pay whatever rate the carriers have filed with the states. So there's no negotiation. Now, one of the changes to the Affordable Care Act was, and there's been a lot of changes since it was first passed in March of 2010, but one of the changes is they rolled back the small group expansion at the federal level. So there was a lot of pushback to the expansion to 100 employees. So at the federal level, the Affordable Care Act rolled back the expansion back to 50 employees. That was actually a big victory because now for those employer groups between 50 and 100 that would have been pushed into the small group, they could stay in large group. They don't have to deal with member level, age-banded rates. Unfortunately, the state of California did not comply with the federal rollback, and they have maintained the small group expansion. So for California-sided companies, you still are subject to the small group expansion, and the small group goes up to 100 employees. So we have, particularly for companies between 50 and 100, they've had to transition, and this is the last year for that transition, can no longer grandfather, where you're going to have to move into the small group. The second group is what we call the mid-market. Mid-market is defined as 100 to 250 employees, 101 to 250 employees. With most carriers, this mid-market falls into what we call a pooled underwriting arrangement. What that means is they take all of their employer groups in this size segment and actually rate them as a pool and give them the same renewal increase. So if you're in the Cigna pooled arrangement, you've got 175 employees and you've got an October 1st renewal date, all the groups in that segment that have an October 1st renewal date get the same increase for their HMO or their PPO or their high deductible health plan. Now there is some room for negotiation there. Typically what we do at Filice is we're going to go out and do a full market analysis. And if you're with Cigna and we're able to go to United Healthcare and get you a better rate structure, we will then take that back to Cigna or whoever your incumbent carrier is and say, if you want to keep this business, you're going to have to drop your rates to be more competitive because the marketplace is telling us that this company, your group, is rated differently than the renewal increase that they gave you. The flip side of it, though, is that if you are a high utilizing employer group, you guys have a lot of claims, you actually can benefit from the pooled arrangement in that you get a little bit of protection and they're not rating you specifically on your claims, but they're rating you with the pool, and oftentimes that can provide you with a little bit of protection and a little bit of stability. Over the last couple of years, we have seen these pooled arrangements range from, the increases have ranged, the initial, at least, renewal increases have ranged from 9 to 13 or 14%. But we've had pretty good success in aggressively marketing these accounts and getting some rate relief for companies that where it's appropriate and where the market tells us, hey, we can do better than the incumbent. Third segment is for groups that are 250 or more employees. We refer to this as the large group. Groups of this size are actually rated partially on manual rates, so what the actuaries say, this size group with your demographics, et cetera, should look like, and then partially rated on your actual claims experience. So this gives you a little bit of protection on the manual rating, but it also gives you an opportunity, if you are actually performing better than expected, you can get lower rates, and there is much more room for negotiation there in terms of, hey, our loss ratio was 74%, and the target loss ratio for groups this size is 80%. We're coming in better. We don't deserve the renewal increase that you've given us, and it provides us much better business case to actually negotiate a more favorable renewal. Again, I want to remind you, if you have questions as we go through this, we do have moderators managing the Q&A, so feel free to type in questions. Alternative funding. What is alternative funding? Alternative funding is most plan designs, or all of them in the small group, most of them in the mid-market, not as much, but still a large percentage in the large market, are fully insured. Fully insured is simply you pay the insurance carrier a monthly premium every month, and the insurance carrier pays the claims outside of your co-pays and co-insurance. Alternative funding mechanisms refer to self-insurance, and there are different levels of self-insurance that we're going to review. But in a self-insured model, the employer group assumes financial risk for some of the actual utilization and some of the claims paying responsibility. And there are varying levels of financial risk that you can take. What level you want to take oftentimes depends on the demographics and location of your group, your claims paying history, and frankly, it somewhat depends on the organization's appetite for a little bit of risk. A lot of that comes down to really understanding the difference between the perceived risk. What I mean by that is some people hear self-insurance and they immediately think of a $5 million claim, and if we had to pay a $5 million claim, we're going out of business, versus real risk. And when you really look at the data and you look at the different components of a self-insured model, there are ways that you manage that risk so you would never pay a $5 million claim. And we'll get into a little bit more specifics of that as we go through the presentation and look at the different alternative funding mechanisms. How common is alternative funding? Kaiser Family Foundation statistics are shown on this slide. Kaiser Family Foundation runs surveys, multiple surveys throughout the year, but they tell us that about 17% of companies with 200 or fewer employees utilize some form of alternative funding. Companies in the 200 to 1,000 range, over half of them utilize some form of alternative funding. And then when you look at large enterprise-level organizations, 5,000 or more employees, almost all of them, 94%, utilize some level of self-insurance or alternative funding mechanisms. When you think about self-insurance, what do companies typically self-insure, either partially or fully self-insure? Medical and prescription? Absolutely. Dental insurance? We look at dental insurance, and typically if a company's got 150, 200 or more employees, we're taking a very close look at dental insurance on a self-insured basis, because it's very rare that organizations won't save money by self-insuring at that level. Short-term disability. This is something that companies, again, this is a little bit bigger, but companies 500 or more employees, we oftentimes will at least evaluate a self-insured model. It doesn't happen as often, but it's something to evaluate, and it's only for the short term. It's not for the long term. The reason being is that short-term disability has start and end date. Start date's going to be either on the 8th day of disability, the 30th day of disability, maybe the 90th day of disability, but it runs for a finite period, okay? Typically no more than 1 year where you would be paying those disability claims. The reason we don't look at long-term disability is because if someone becomes totally disabled and you're self-insured, they receive disability benefits, or can, depending on the plan design, up till age 65. And if I'm 27 years old and I get into a bad car accident or I get really sick and have a medical condition that prevents me from working, there's 30, 40 years of long-term disability payments, which equates to significant financial risk, which is why we do not see companies self-insuring long-term disability. And then vision insurance, again, kind of like dental insurance, something to evaluate. There is some benefit there. We don't see it as often in vision just because it tends to be a pretty inexpensive benefit, and so companies tend to stick with a fully insured model for vision, but it's certainly an option to do so. So getting into different alternative funding mechanisms, and we're going to kind of go with, move from kind of the lowest financial risk up to the highest financial risk. Health savings account. Health savings accounts. Again, as I indicated previously, these came into play with the Medical Modernization Act of 2003. What is a health savings account? It's a tax-exempt savings account owned by the individual. So not owned by the company. This is an individual account that you open up just like your B of A checking account, your Wells Fargo savings account. But it's restricted solely for the use of paying for qualified health expenses that are not covered by your health plan. So a health savings account actually has to and can only be opened up in conjunction with enrolling in a high deductible first dollar deductible health plan. So if your company offers a high deductible plan that is an HSA compatible plan, you can then open up an HSA account, and both the employee and the employer can contribute to this account up to IRS regulations, and any contributions into that account from the employer are tax-free, so there's no taxes paid by the employee, and any contributions made by the employee into their HSA account are 100% tax deductible. Again, these dollars can only be used for qualified health expenses, and you can only contribute to an HSA account if you are on a high deductible health plan. From a tax perspective, it's important to note that there are a handful of states, California being one of them, that do not comply with the federal tax treatment of HSAs. So what that means is, if you're a California resident and your company makes contributions into an HSA account on your behalf, you actually do pay California state taxes on those dollars. And if you contribute as an employee into your own HSA account, it is not tax deductible at the state level. So you still get the federal tax benefit, but you do not get the state tax benefit as a resident of California. Another benefit of an HSA account is you've got an HSA account, high deductible health plan, you've built up some assets in there through either employee and or employer contributions, and then you go get a new job, the HSA account stays with you, okay? It's not an employer account, it's owned by the employee, and you can continue to use those dollars to pay for qualified health expenses. And that includes both medical expenses, dental expenses, vision expenses, anything that is a medically necessary expense. So you can use it for, LASIK eye surgery, for glasses, for orthodontics, whatever. Those are all qualified health expenses. Second alternative funding mechanism are what's called health reimbursement arrangements. Health reimbursement arrangements are similar but with some significant differences to an HSA. A health reimbursement arrangement is an account that is owned by the employer, where the employer will say, hey, we are going to allocate a certain amount of dollars to each employee to help pay for medical expenses that are not covered by the health plan. So it can be deductible expenses, it can be co-insurance, it can be co-pays. You can structure it however you want, but the dollars are only spent if you actually utilize the plan. As opposed to, so let's just use an example. Let's say you've got a $2,000 high deductible health plan in place and you are using HSAs. And the company says, okay, we're going to take the premium savings that we have generated by going to a high deductible health plan, and we're going to contribute to our employees' HSA accounts. We're going to give each of them every employee $1,000 to cover deductible expenses. That $1,000 is a fixed cost. You've got 100 employees, you're going to give each of them $1,000. It's a $100,000 fixed cost. Under an HRA, say you've got the same $2,000 deductible plan, and you say, we're going to allocate under a health reimbursement arrangement, an HRA, $1,000 per employee. But those dollars are only spent if the employees actually utilize the plan up to that $1,000. So where you have allocated $100,000, very rare that every employee will spend $1,000. So it goes from a fixed expense when it's an HSA contribution to a variable expense under the HRA model, in that you only actually pay those expenses if the employees each utilize their $1,000. HRAs give you a lot of flexibility in that you can structure it and say, hey, you know what, we're only going to cover deductible expenses, employees responsible for co-pays or co-insurance. HRAs do not need to be put in place only with a high deductible health plan. You can do it in any way that you want. In any plan design you want, you can incorporate an HRA. And again, as I indicated, it's a variable expense for the employer because you only pay those dollars if your employees actually utilize the health plan up to the allocated amount. The other thing we like about HRAs or HSAs is the ability to incent wellness-related behaviors or healthy behaviors. And what I mean by that is you can tier it and say, hey, going back to that same $2,000 deductible plan, you can say, we're going to give every employee $1,000. That's our base contribution under either an HSA or an HRA model. But what you can then say is, however, if you perform these healthy behaviors or these wellness-related behaviors, we're going to actually give you $1,250, so an extra $250. So one of the things that we've done, we think it's really important for employees and their dependents to get their annual physical. Really important to know your numbers, understand, what's my cholesterol, my glucose, my blood pressure. See your doctor, engage in your health care. So oftentimes, we've structured with companies via the HSA or HRA model, we're going to vary the contribution, and we're going to give a higher contribution for employees that complete their annual physical and corresponding lab work, and that sign a non-smoking affidavit or enroll in a smoking cessation course. If you complete those healthy behaviors, you get a higher contribution via the HRA or the HSA, and the company will pay a higher percentage or a greater amount of your utilized expenses, your healthcare expenses. So again, we like the HRA and the HSA as vehicles for wellness-related incentives. The next level of alternative funding or self-insurance is what is called level funding. Level funding was really kind of brought to the market about 5 years ago. Cigna was the leader in this. Some of the other carriers have established similar programs, but Cigna still is far and away the leader. And level funded refers to, I think the easiest way to look at it is, it's a fully insured medical plan, and you can have any plan design you want under level funded, traditional, high deductible, hybrids, whatever. But what level funded provides you is the opportunity to get money back if you actually perform better than they expect you to from a claims perspective. So what this means is you're going to pay, just like under a fully insured model, you're going to pay a premium every month to, and I'm going to use Cigna here because they're the leader in this with this model, but you're going to pay a fully insured premium every month. Generally speaking, for every dollar you pay in premium, they allocate about 2/3 of those dollars to claims funding and 1/3 to administrative. So let's just say that you pay $1.5 million in premium. They'll allocate $1 million of that to claims funding over the year. If your actual claims come in at less than $1 million, they will refund a percentage of that savings back to the company. That refund is typically, under most plan designs, either 50% or 66 2/3% that they will refund to you. So let's just say you're at a 50% refund model, and your claims funding allocation is $1 million, and your actual claims come in at $800,000. They're going to refund 50% of that savings, so 50% of that $200,000 or $100,000 back to the company. Let's say they've allocated $1 million to your claims, and your claims come in at $1.1 million. They pay that extra $100,000. They don't come back to you for that. So that's why I refer to it as a fully insured model that actually sits on the self-insured platform. But it gives you the opportunity to get a refund if you actually perform better than they expect. Probably the most important thing that I like about level funded is it gives you access to data. For our clients that are on Cigna level funded, we get all their claims. And so we are able to get full transparency into what medical conditions, what prescriptions are driving your claims costs. So oftentimes, when companies start thinking about moving to a self-insured model, the level funded is actually a pretty interesting interim step for a year or two to actually get data and be able to evaluate how are we performing? What are our major levels of concern from a medical condition, prescription drug? What can we do to address those concerns to make going self-insured more attractive for us? So we like it as an interim step. We like it very much in the mid-market. We've got clients as small as 25 employees that are on the Cigna level funded plan. They perform well. They get great. They get a refund at the end of the year, and they're able to save money because they're coming in at less than expected claims. So it's a really good opportunity to get a refund, to get data, be able to evaluate that data. We've made quite a significant investment here at Filice in a clinical staff. So we actually have nurses on staff here who actually take all your claims data, do a clinical analysis, and provide you with what's called a state of the plan report, and gives you all that visibility and transparency into what's driving your claims. That clinical perspective also allows you to to say, hey, do we need to make some changes around our plan design, or do we need to incorporate wellness activities or initiatives or health intervention strategies to address certain medical conditions that may exist in our population. I'm a big believer that if you can't measure it, you can't manage it. So having that data available to you to analyze and evaluate and ultimately make decisions based on data is really important. For those of you that are under fully insured platforms or plan designs, you know that you just don't get data until you get above 250 employees enrolled in a plan. So this is an interesting model and opportunity for you if your company is in the mid-market. The next evolution would be, hey, we want to go self-funded. We don't want to do this, HRA, HSA, make some contributions. We think level funded is interesting, but you know what? We want to go self-funded. We want to jump into the deep end of the pool. Now again, making that decision requires a little bit of evaluation around your demographics, where you're located, what carrier makes sense. And again, having data allows you to make much more of an informed decision in terms of what financial risk you actually are taking. But self-insured has become much more popular with companies with lower numbers of employees than we have traditionally seen, because we're typically able to structure this in a manner that allows you to kind of capitalize on the difference between perceived risk and real risk. There's two ways you can self-insure. One of it is called, you'll hear ASO thrown around. That's administrative services only. That's your bundled service, or you can do it with independent providers on an unbundled basis. The bundled model is basically you go to a carrier, you go to Anthem Blue Cross and you say, I want to self-insure. Your benefits consultant goes and gets a proposal, and Anthem or any other carrier comes back to you with a proposal that incorporates, number one, access to their network. Why is that important? Because you then get their discounted contracted rates. You're paying wholesale rates for these claims that you're paying versus retail rates for these claims that actually save you a lot of money. Each carrier has different kind of contracted rates. So, depending on where you're located, your demographics, that becomes very important. Second piece of it is the administrative piece related to claims. So they're going to adjudicate all the claims. They're going to pay all the claims to all the providers for you. And then they'll just draw money from your account based on the claims that they have paid. And then the third piece of it is your StopLoss insurance. They will provide that as well. In most cases, when you self-insure on a bundled basis with a specific carrier, it's going to be more expensive than if you do it on an unbundled basis. On an unbundled basis, we would go out to the market and we would get the three pieces for you. Number one, we'd go out and we'd find what's the best network for you, and we would generate a proposal from the different carriers, which is a monthly per employee per month charge to have access to their network. So going back to Blue Cross, we would say, hey, Anthem, we want to utilize your network. We would pay them for access to their network, which really means access to their network discounts. So if we went with Anthem Blue Cross, your employees, it would oftentimes be seamless to them. They would know we're insured by Anthem Blue Cross. They wouldn't really need to know that the company, the employer, is actually paying the claims. Second piece of it is we would go out to a third-party administrator, and they would act as your claims administration arm. So they would adjudicate all the claims. They would provide services around claims resolution. They would pay all the claims, and then they would draw the money from your account to actually pay for the claims that they have paid for on your behalf. And then the third piece of it is we'd go out to the stop-loss market and we would negotiate the most favorable rates for your stop-loss, which allows you to manage your risk on both a specific and an aggregate stop-loss basis. So again, in most situations, it's a little bit more complex, but if you go with an unbundled model, it's going to be more economically viable for you than if you go with the bundled model, specifically with a carrier. What are the two types of stop-loss insurance? Far and away, the most expensive piece of it is your specific stop-loss. Specific stop-loss refers to the protection that is provided when any individual meets your specific stop-loss. So again, depending on the size of your group, depending on the demographics, where you're located, we would identify what's the most appropriate stop-loss number. So let's say you're 350 employees, you want to go self-insured. We go out and we set the stop-loss number, the specific stop-loss number at $75,000. What that means is for any individual on your plan in a plan year that exceeds $75,000 in claims, you, the employer, would pay the first $75,000. Anything beyond $75,000 would be covered by the stop-loss insurer. And again, we have clients that have, that say, hey, we want to be pretty conservative. We don't want to pay more than $75,000 or $50,000 for any specific individual. To other clients that are much larger, they've got 2,500 employees, and they're like, you know what? We're going to set our specific stop-loss at $200,000. So we're going to pay claims up to $200,000, and the stop-loss insurer will pay anything beyond that. Clearly, if you set your stop-loss at $75,000, your stop-loss insurance is going to be much more expensive than if you set it at $200,000, because the stop-loss carrier starts paying claims for anything above $75,000 on the former. On the latter, they don't start paying claims until $200,000. So we've shifted the risk to the stop-loss insurance company when it's at $75,000. If we go to $200,000 or $150,000 or whatever the number is above $75,000, we've shifted more of the risk to the employer, less of the risk to the insurance carrier, and hence the actual insurance is less expensive. The second piece of stop-loss insurance, much less expensive because it very rarely gets hit, but the second piece is your aggregate stop-loss insurance. What that refers to is it's the protection provided to the employer when your total claims exceed typically 125% of your expected claims. So let's just say you self-insure, and they say, okay, based on the number of people you have on the plan, your demographics, location, etc., we expect you guys to hit $1 million in claims. So they'll set the aggregate stop loss at 125% or $1.25 million. If your claims exceed $1.25 million in aggregate, the stop loss carrier ends up paying any claims over $1.25 million. Again, this is a much less expensive. I've never had a self-insured client that actually hit their aggregate number, which is why it's not nearly as expensive as the specific stop loss. So what are the advantages of alternative funding? Number one, every carrier on a fully insured basis underwrites companies with a profit margin built in, right? So there's a claims paying allocation, there is an allocation for administration and sales and all that stuff, and then they obviously want to make money on it. If your self-insured model is structured appropriately, we can take that 8%, 10%, 12% profit margin that they underwrite on a fully insured basis and let that benefit go to you, the employer, as opposed to the insurance carrier. Now again, having data and understanding what's driving your claims is really important, particularly if you're in the mid-market. If you're in, with my clients that have 1,000 employees, 2,000 employees, StopLoss is really kind of a no-brainer because we know we can structure it with the stop-loss, or self-insured is really a no-brainer because we know we can structure it with the appropriate stop-loss insurance to save them money. It's just kind of the law of large numbers. You're going to have some people that are heavy utilizers, but you're going to have most people don't actually utilize that much. In fact, statistics show that about 80% of healthcare expenditures are generated by 12 or 13% of the population. And so we're trying to, win that arbitrage battle on a self-insured basis and allow the benefits to go to the company as opposed to the insurance carrier. The second important reason why companies like self-insuring is it provides you with a higher level of flexibility in terms of plan design. We can do anything we want. For those of you that are on fully insured, you know that there might be a little bit of flexibility, but they've got basically off-the-shelf plan designs, whether it's a PPO, an HMO, whatever. Here's your copay, here's your coinsurance, here's your deductible, here's your out-of-pocket maximum. On a self-insured basis, we build that plan however we like. We want $5 copays, done. We want $0 deductible, done. We want out-of-pocket maximums to be $1,000, done. So we can do whatever we want in terms of structuring the plan design. And so that level of flexibility really allows you to carve out plan designs or design these plans to really meet the needs of your population. What are some of the challenges with alternative funding? Again, I talked about risk. There is some financial risk. However, I'm a big believer that if you structure your self-insured plan design and your stop-loss insurance the appropriate way, there is a big difference between perceived risk and what is the real risk. And so, based on, clearly if you're a really, really, really sick population and you've got a lot of heavy utilizers, stop-loss may not be the way to go if you're in the mid-market. However, oftentimes you can structure it to really allow you the opportunity to save money and move that carrier profit into your back pocket. Even if you're in the mid-market, or 250 or more employees, whether you're on a fully insured basis or if you're self-insuring, you're going to pay for your claims one way or the other. If you have a really bad year in the fully insured and you're above 250 employees, so you don't have a lot of protection from that pooled arrangement, you're going to pay for the claims via a big renewal increase. However, if you have a really good year and you perform really well under a fully insured, you're not going to get the benefit of having a really good year. Okay, because you're still going to have paid all those premiums. Whereas in a self-insured model, you're going to pay the claims, and if you have a really bad year, you're going to pay the claims. Your stop-loss insurance will go up, but you also have the opportunity to win in that, hey, we had a really good year. We came in at 60% of expected. All that savings goes to the company as opposed to the carrier. So again, having that access to data and that transparency really allows you to make much more informed decisions. The other somewhat of a challenge comes with employee communication. Hey, you know what? I've got a service to, if particularly at an unbundled self-insured model where you'd be calling the TPA for services as opposed to Anthem oftentimes. They don't really need to know that the company's paying the claims. It doesn't really matter to them. They're really more concerned about what's my premium, what am I paying for my premiums each paycheck, and what are my copays, what are my coinsurance, what's my deductible. Those are the things they worry about. But there is, the card looks a little bit different. It may have an Anthem logo on it, but it'll also have your TPA's logo. So there's just a little bit of additional communication that occurs there, but nothing that's too egregious or too difficult to overcome. How do you make the decision? Again, data is the most important thing, understanding how you guys perform as a population. And again, particularly if you're on the smaller side, if you're above 1,000 employees, I think it's almost a no-brainer to self-insure. But having data is important if you're going to self-insure. And that's why we kind of talk about sometimes there is a process. You may want to start with an HRA, HSA model or with a level funded model. Allows you to get more data and then be able to take a look at, what sort of claims are driving your utilization. What can we do to better address those claims and bend that cost curve downward? The demographics of your group. Statistically speaking, younger people utilize less than older people. I think I can say that. My compliance department won't get mad at me because I'm a 50-year-old bald man, so I'm probably one of the high utilizers. But it's, younger people tend to be a more attractive demographic. And then there is, companies' attitude or appetite for risk and being able to delineate the difference between perceived and real risk. So having an advisor or a benefits consultant that can help you really understand the self-insured model, the different structures that exist, and what's most appropriate for you and your demographic is really important. Again, we kind of just talked about the long-term approach, evaluating your demographics, your location, your appetite for risk. Starting off, maybe dipping your toe in the water with a level funded or even a, high deductible health plan. And then really having access to data and that transparency and visibility that allows you to make the most informed decision possible. That is all I have. I am hopeful that this was a good communication and education for you guys. Please feel free. We're going to leave this open for Q&A if anybody has any questions that they want to ask the moderators, who I'm assuming have been actively responding to questions throughout the webinar. You will also have contact information if you want to follow up at a later date. I'm happy to answer any questions that you have or provide any analysis or evaluation that may be of interest. And again, thank you for your time this morning. And that is the end. Our next webinar will be Best Practices in Health Plan Management on August 17th at 10 a.m. And you can register at our website at www.filice.com. Have a great day.